Hey, good morning, options traders. Welcome back, everyone, and a special welcome to all of the new traders we have that have joined us here recently. It's great having you here. And in a recent coaching call, I had a good conversation with one of the traders talking about the difficulties of finding out your max gains and losses when you have synthetic positions in the account. And what happened with this trader is he wasn't even aware that he had them. And so I thought it might be something helpful to pass along to everybody else. Now, even if you're not familiar with synthetics, it can still be an important message that you have to be careful when you start mixing calls and puts. So, for example, let's take a look at a credit spread. Let's say that you buy a $100 put trading for $10. So this is the price you just paid, and it could be on the same ticket or at a later time. You sell the 110 put and collect 13. So this is a bull spread, it's a credit spread, and in this example, it's a net credit of 3. That's just the net cash flows between these two. Effectively, you sold this put for 13, you took 10 of those dollars to buy this put, and therefore it left you with $3 in your pocket. That's a credit spread. Now, if we look at this graphically, it's going to look like this. It's a bull spread. So we see the bend at the $100 put. I always talk about the bends in these graphs. Here's one right here at the short 110 put. And because you received a $3 credit, that's your maximum gain. But because you have a $10 difference in the strikes, the most the spread could move against you is $10 minus the $3 credit is a max loss of $7. So let's say that for whatever reason you decide to buy back this 110 put. You want to turn this from a bullish position to a bearish position. So if we buy back this 110 put, you're just going to be left with the long 100 put. It'll be an unlimited bearish position. So here's what traders will do. They'll say, all right, let me buy this 110 put back. Let's say it's currently trading for 5. And they'll say, well, if I spent 5 and I previously collected 3, I therefore have $2 into my resulting position. I must own the $100 put for an effective cost of $2. And if we were to do these trades, we would find out that's exactly correct. You're long the $100 put and your max loss would be $2. So they think that this works for all positions. Just sum up those debits and credits. Well, let's go back to the beginning. Let's take a look at this credit spread for 3. And let's say that instead of going to the bearish side that we just saw, you wanted to go to the bullish side. And I could do that synthetically by just spinning out this 110 put right here by buying the 110 call. And so just for the example, let's assume that it's trading for the same price of 5. So if I do that, I've effectively canceled this position, and that's going to leave me a synthetic long stock position plus a $100 put. It's going to give me a $100 call. But the question that I have is, do I own the $100 call for $2? Because again, this is a trap that traders will step into. They'll say, well, I collected 3, I spent 5, therefore I now own the $100 call for a cost of 2. And if you put this into your account, surprise, it's not 2, it's 12. Well, that's a big difference. If you were willing to put this money at risk because you thought it was only $2, that's one thing. But it's 12. It's 6 times higher than what you thought. So how did this happen, and how could we have figured out our true net cost? Well, one way is to go back to our vertical spread. Yes, we received a $3 credit, but if I want to look at things in terms of debits, I would have to say synthetically I bought the call spread for 7. Right? We've talked about this relationship before. If the put spread is selling for 3, the corresponding call spread must cost 7. So even though I received a credit of 3, in my mind, I'm visualizing this as though I spent 7 for a call spread, and now I'm going to buy a 110 call on top of it for 5, so therefore I have spent a total of 12. And whatever the resulting position is, I must have a maximum loss of 12. So that's one way of looking at it. But the way that I prefer to teach traders is to look at it through synthetics. That will always give you probably the easiest way to come up with the answer and always the correct answer. So let's go back to saying that we bought the $100 put for 10. We sold the 110 put for 13, net credit of 3, so far so good. Now we buy the 110 call for 5. Well, let's pair some things up synthetically. See how I've mixed calls and puts? I might have some box positions in here or some synthetic positions, and that can greatly change things. So one thing that jumps out at me is the 110 call, the long one, and the short 110 put. What is that? Well, a long 110 call and a short 110 put is the same thing as long stock at 110, at that strike. Mathematically, that's exactly the same thing as if I went out right now and bought stock at 110. Well, but I also have this $100 put that was in my account. So if I have long stock at 110 plus a $100 put, how much of that is a potential loss? $10, right? The stock could fall from its current price of 110 or its effective price of 110 all the way down to 100, and that's a $10 loss to me. So that's one thing I would look at, but then on top of it, I could now combine these debits and credits. If I received a credit of 3, I just spent a debit of 5, that's an additional $2. So if I have a $10 synthetic loss and a $2 debit, there's your $12 maximum loss. So the thing to understand is that you have to be careful when you are mixing calls and puts. You can get synthetic relationships, box positions, all kinds of things that can happen that can alter your max gains and losses. And like I always tell traders, if you don't know what your max gains and more importantly your max losses are, there's no way you can make good financial decisions. So if you're ever unsure, just throw it into something like Excel or Thinkorswim's Analyze tab. A lot of the brokers will let you do hypothetical positions to see what those max gains and losses will be. So until you get really good at understanding these, I would always do that as a backup measure. So for anyone who'd like to learn more about the art and science of options trading, please check out the Alpha Trader course, Strategy Lab, and a brand new technical analysis course. It's all at optionsatoz.com. Also, please join us on the Facebook trading group, Options A to Z, and you can find a link in the description below.